Hey, I hope you're all doing well out there. This is your September market review. So for those of you that are new to watching these videos, my name is Dan Westfall. I'm a certified financial planner. My company is Client Focused Financial. The reason that I put these videos together each month is to give my clients the straightforward information about what's going on in the stock market and the economy, and ultimately how that affects their investments that I help them manage. So we're continuing to have a great market, with the stock market continually moving higher for the year so far. As you can see on this chart, we're up a little over 15% on the S&P 500 for the year. Another great, follow-up to 2023 and then 2024 last year. So not quite as high as what those years were, but still another 3 months to go here in the last quarter of the year. So we'll see kind of how things continue moving. Right now, like I said last month, there isn't really any bigger things that are kind of potential real big headwinds for the market. The government was shut down for a period of time, and it's something that typically would be a little bit of a headwind, but right now really isn't for stocks, at least thus far. So big thing that happened in September was the interest rates being cut here a quarter point. That was a big thing. It was really kind of talked about, where it was just kind of widely known by markets that the Federal Reserve was going to come out and cut interest rates by a quarter point, which would help out with basically the economy, where right now we have the jobs market is a little bit still really good, but there's a little bit of what's called softening, where it's not doing as well as it could be doing. As far as new jobs being created versus unemployment. So the chart that I have here right now kind of shows some of the economic metrics that are out there. So there's on the very top part of the chart, there's the Federal Reserve upper limit, which is at 4.25% right now. And then there's then also unemployment right below that, which is at 4.3%, and then U.S. inflation, which is just under 3%. So unemployment has gone up a little bit recently, but full employment is considered where there's an unemployment rate of about 5%. That's healthy, just because of people changing jobs and there not being too many positions that or just basically too many companies that can't hire, or that can't find people to hire. So it's good that there's a little bit of unemployment. Typically 5% is kind of statistically the number that is considered full employment, though. Inflation over the long haul around 3% is typically the kind of like status quo over the last 100 years. Inflation has been right at about 3%. The Federal Reserve would ideally like it down closer to 2%, so not very far off, but it's kind of been sticking right at that 3% level for a while now. So from an economic standpoint, where everything is going relatively well right now, there isn't any major things to report there. Bigger things that I'll talk about here in the charts, just because they affect, if you're a client of mine, they affect your portfolio. One of them is just kind of looking at some changes that I made in September for IRAs, and then the last thing I'll look at is kind of like looking at, optimistically at some of the things that could happen if markets go down, or as interest rates continually move down. So first thing to go through, though, is the change that I made in portfolios for IRAs back in September 15th, a few weeks back. I'm shooting this October 6th here. So mid-September, one of the changes that I made is I cut the energy position. So the reason that I did that is just because the energy right now has been in a trading range, not to get too in the weeds of it. Until it breaks out of that trading range, I'd rather just not keep money sitting there while it's just kind of oscillating back and forth in this tighter window. So what I wanted to do with that position, it's about 4% of the portfolio there. What I did is I took 2% and added it to semiconductors, and then the other 2% and added it to the communication services sector. So communication services since September 15th, down a couple percent. Kicked myself a little bit for making that change. The energy position is only up 1%, S&P is up 2%. I pat myself on the back for the change that I made with the semiconductors, though, where that's up 12%. So win one, loss one. The win was bigger than the loss, which is good. So that was a nice change within the portfolio. And while it's only a couple percent that went to that, that was a 10% difference move for that 2% there. So that adds up over time. So this is just one change that I made. I'm going to start kind of pulling these changes up as I do them, just so that way you guys can see kind of why I'm doing them, other than just seeing confirmation statements come through or an email notification where you're like, what's going on? Is Dan must be doing something. I am. So I made that change for that reason. But in these videos, I'm going to start kind of going through a little bit more of why I'm making those changes. So then that way you get a better understanding of that. If you're not a client of mine, you should become one. If you have money, I can help you with managing that so you can make more money on your money like the rest of my clients. So, but those are changes that I make for client portfolios, just periodically looking at research that I do based on market movements and where positions are within the overall market and where that based on my research I see them going. So those are just some of the things that I'm doing behind the scenes. One of the things I came across, and for those of you that are newer to watching these videos, I go over a ton of charts because I think charts are a great way to depict a real intangible thing like stocks and investing. So that way you can put a good visual to what I'm talking about. One of the charts that I came across was in a Wall Street Journal article this past month, looking at the investors' perception of the crash probability. This one chart here is since 1999. So there's this common theme that I've heard from my clients or even prospective clients over the last 4 months or so, and a lot of it I think is just because of the media people are listening to, which is one of the reasons I put these videos together, is that there's this common theme out there that the stock market isn't doing well, which clearly factually isn't correct because we're at an all-time high right now. But the other thing, when people do know that it's doing relatively well, they might not know that it's at an all-time high, is that they think that it's going to then crash because there's this thought process that what goes up must come down. And while the stock market does fluctuate, it doesn't have this gravitational pull to always drop back to the floor. Over time, it actually has a gravitational pull to continue moving higher, kind of like reverse gravity over time, actually. So this chart, though, I thought was interesting because it depicts that same thought process that individuals I talk to have in a chart form, looking at a survey that's been taken since 1999 of individual investors versus institutional investors, and their thoughts on the possibility of a crash. Institutional investors are more like large investment firms, hedge funds, basically big money. So versus individual investors, obviously everybody that's watching this is an individual investor. So institutional investors generally are more considered smart money. They're not going to be making irrational, dumb decisions with their money more times than not, versus individual investors are looked at as making dumber decisions with their money as a whole. So don't take it personal, just the numbers. So individual investors obviously think that there's a higher probability of a crash right now, which is something that I look at as a sign that the overall market is probably going to keep moving higher, because when you get individual investors thinking that there's going to be a potential crash, that's meaning that they're probably not investing or fully invested right now, which leads into another chart that I have of assets in money market funds. So this goes back here a number of years and just shows I think this is like a 10-year chart here, going back looking at what the assets in money markets, which basically is a cash equivalent, has been, and where it's at right now, where it was at one point about 2.5 trillion. Today, it's pushing up on about 8 trillion in assets in money markets or cash. So this is just a lot of money that's sitting there not really making that much. So as interest rates go down and the Federal Reserve lowers interest rates, the money that people that are investing in money markets is also going to go down. So if there's individual investors out there that have money sitting in cash, they're now going to be making less on their CDs or their high yield savings accounts. And at some point, they're going to hit that spot where they're going to get FOMO when stocks are up 15% and when it hits the broader, group of people out there that just aren't paying attention to the stock market moving higher. Then they're going to start investing their money, and that's when maybe markets will get overvalued at that point. But definitely a sign that we still have a lot more potential room to run. Another chart I have here is just showing money market yields, which kind of goes hand in hand there with interest rates dropping. So money market yields are about 4% right now, right in line with where the Federal Reserve Fed funds rate is at the moment. So one of the other good signs with there being so much money being in money markets right now, and there's just a ton of cash sitting there, even with us being at an all-time high, that's a great sign, because if we do go through a bigger drop, there's a lot of people that have money that is only making 4% that are likely to take the opportunity at that point to invest that money into the stock market. So I don't see a huge market drop being anything that's very extended. So if we did have a 10 to 20% drop in stocks from where we're at right now, it probably wouldn't be that long until all of a sudden we're right back up to those market highs again. And I bring that up because I want you guys as my current clients, and if you're a prospective client out there, or just somebody watching this trying to get more information, I want you to understand that when those dips do happen, it's probably not going to be very long. So, don't sit on the sidelines and wait for it to keep going further thinking you're going to get a bigger and bigger sale. A 15% sale is better than no sale at all, and it's also better than a missed opportunity. So there's ways to go about getting money invested in those opportunities. If you have money that you're looking at getting invested right now, even though we are at an all-time high, one of the things I'll point out, and this is just it goes kind of against common thought, is that typically you don't want to buy, or at least the common thought would be that you don't want to buy when stocks are at an all-time high. But most all-time highs are then led by future all-time highs. So even buying at an all-time high, you're likely to not be buying at the worst time, because stocks are probably going to go higher on a probability standpoint. Eventually, there will be that point where we are at a high and markets go down. Statistically speaking, though, there's more future highs ahead of us than there is the probability of us going lower, because we were also at all-time highs 10% ago. So if we go back to that first chart that I pulled up of the S&P 500, the S&P 500, back in June, when the market was roughly at about break even, only up a few percent for the year. It was only up about 5% for the year. We were at an all-time high then, and we've only gone up another 15% or another 10% since then. So all-time highs are led by eventual new all-time highs. So if you have questions or you want to connect about your portfolio or anything specifically, definitely reach out to me. I'd be happy to connect with you and talk about your portfolio specifically. We can connect via Zoom or just chat over the phone, whatever works best for you. If you're somebody that isn't my client, you want to have a conversation, reach out to me. If you're getting this email, you can just reply to the email and I'll connect with you that way. If you're just seeing this on YouTube, go to my website, fill out the contact me form. I'll get that and I'll reach out to you that way as well. If you're a client out there and you have a friend or family member that you think would be interested in having a conversation with me about their investments, I'm always looking to talk to anybody you refer me or introduce me to that just has questions even about their investments, whether they want to work with me or not. Happy to have a conversation with them and just at least point them in the right direction. So introduce me to them. The best thing to do is just get me their contact info or just put us in a text thread together, and I can touch base with them that way. But I appreciate you all taking the time to check me out. Until next time.